emerging markets, Asia and Japan had a very strong Q2, really driven by huge outperformances in Korea and Taiwan, and sort of everything else sort of slightly lower. Beginning of this year, we started a trend where really there are three areas driving emerging markets. The macro environment, because of the rate cycle in the US, was less of a tailwind. But the three main drivers have been one, the AI capex and the fact that Asia has, an emerging market has the picks and shovels of that trade, particularly in semiconductors. The second is the industrial area, the reindustrialization of the world, or fourth industrial revolution, as some commentators call it. The very strong performance of earnings and widening out. And the third is that both of those areas need commodities, and commodities, are in generally a demand-supply imbalance, and that's been very positive. So those have been the real three trends. Interestingly, since the sort of fall in markets and risk off over the Iran situation, we have seen a different pattern come through in the last 6 weeks, 2 months, where it's really been about a sort of leverage bet on AI and everything else has been left behind. And that's led to huge differentiation within markets and within sectors in EM, in Asia and in Japan as well, where the trends are pretty similar. The drivers of North Asia have predominantly been AI and supply chain. They've predominantly been about excess or increasing capex in the huge platforms and the hyperscalers that have led to higher pricing in companies, particularly in semiconductors and the supply chain. Now, the main difference between Korea and Taiwan on this is that Korea has more semiconductor exposure and also has a wider market, where Taiwan is narrower. We have seen the AI trade rotate more into some of the supply chain, to MLCC, to the PC, and that's led to sort of drivers widening out. And in Korea, we also have other drivers, which is the corporate governance angle, and then we have the industrialization, which, as I mentioned, has really lagged. It hasn't been a driver of the last 6 weeks, but still remains very, very healthy in Korea, and support from the government, where Taiwan's really been about a few stocks in the right supply chain. And that's really the same that's been happening in Japan as well. The phenomena in Korea, which has really led to sort of double performance, has been driven by investor flows, and particularly by the retail investor coming in and leveraging up, buying ETFs, which are levered. Originally, these were listed in Hong Kong and the US, and now we have local ETFs available in Korea, which is more tax advantageous and no need to change currency, etc. And that's really fueled, a massive rise in the market. Plus, also, more volatility. We're really focused on the business models, who's benefiting from the sort of supply demand, then the valuations. And then in individual strategies, it's really about the risk control, how much risk we take in these areas. Is it diversified? How can we do that? What's the individual risk there? But it really comes down to earnings and valuation. Coming to this year, really the trend in China has been exporters on the earnings and growth side doing very well, mainly hardware, mainly parts of the supply chain that are very, very important, but also this continuing of China selling cars and buses and other parts to the emerging market world, not relying so much on the European and US markets. And that's been a long-term strategy, which was sometimes sort of labeled as the Silk Road. But the stock market is probably more driven by what's happening in the domestic economy, and the stock market is very heavy with internet companies and large platforms, and they basically are consumer plays, and the consumer's not doing as well. Because really the consumer is driven by the wealth effect, and the wealth effect generally is driven by increased jobs. We're not really having a big recovery in jobs in China because a lot of the tech side is jobless. It's machine driven, it's robotic, it's top grade, or wage improvement. And so one pocket of China has done incredibly well, and we still think will continue to do well, although it has gone up a lot in the last few months, has been anything related to AI again, anything related to the supply chain. We are beginning to see, akin to what's happening with the hyperscalers in the US. We're beginning to see that phenomenon in China as well. The interesting thing for Japan compared to the last few years is it was actually really seeing some quite strong inflows into Japan from foreigners, sort of reallocation. I think when you look at markets like Taiwan and Korea, they're quite narrow, the generous investors, and they've gone up a lot. So Japan's in the natural world, the trend's the same. So it's been an interesting market, but the underlying trends are no different from what we were talking about in the drivers of emerging markets in Asia. So AI, CapEx, the reindustrialization, and the commodity side. And and then I suppose in one way we've got the domestic economy, which is benefiting from a bit more inflation. So potentially the financial area looking a lot better. It doesn't have the earnings delta of North Asia. So you are seeing it in certain sectors, and this is really because it's such a wide market. But at the end of the day, you have still huge upward pressure on shareholder activity, increased dividends paying out, more buybacks, better financial management. Just it's a lower earnings play on that. When we look at valuations in Japan, it's expensive relative to history. But then we have this new phenomenon of growth coming through. In one way, the political situation in Japan is probably, and the sort of central bank policy probably demands a lower valuation than history. But then the growth angle, the diversification angle, the value up angle demands a higher valuation. I think a lot of people getting very excited about India because of the oil price potentially coming down. We've been underweight India. There are better ideas in Asia. It's not cheap enough to be a value market. Earnings have still been downgraded. Valuations haven't come down, partly because it's supported by a really very robust domestic savings plan that keeps it up. I think maybe another way of phrasing it, what would make us add to India? And to me, one is we have a change in the AI sort of thematic, and we want more balance. Or two, there's a new growth driver in India. And at the moment, we don't see that. There's nothing wrong with the market. There's nothing wrong with the economy. It's just the delta's not there like the past. And, we also have the structural issues of the composition of the market, but it's very heavy in IT and it's very heavy in consumer. Of Singapore, it's obviously not an emerging market, but it's in Asian strategies. It's benefiting from most of the trends that we're seeing. Indonesia has been, although it's bounced recently because it got really too sold off, it's really worrying what's happening on the politics side. And the Philippines is more of a pure oil play. It's very challenged on a higher oil price in terms of its current account deficit and its fiscal deficit. Yeah, Vietnam we like as a structural market, but yet again, exposure there is lower than it has been a number of years ago. We did reduce some quite relatively high exposure to Vietnam into the tariff situation. Actually, Vietnam, like China, had actually ended up having a better deal on tariffs with the US and better relations, and that hasn't changed. I think LATAM. I think really the third quarter, beginning of fourth quarter of 25, you saw huge amounts of money going into EMX China. China had done well. People like looking for new markets. The AI theme only just really starting. The value up theme in Korea starting. People are like looking, well, where else is going to do well? And a lot of money came in and it re-rated Brazil massively. Then the commodity side with rates going down, the US dollar being weaker, all the smaller markets like Peru, Colombia, Chile did well because, and the commodity side of Mexico because commodities were in favor. There are some great companies there, but it's really driven by what's happening on the macro and the politics. And greatest case is Brazil, which has massively underperformed since the end of March. And it's really because, one, the expectations for interest rates are to come down a lot, and we were expecting 400 basis points. That's been delayed. And there's an election. Now it's not looking so good. So, normal LATAM, it's a very good opportunity to be tactical, but yet to be structural. Yeah, I mean, EMEA, an underperformer in the quarter, underperformer year to date. Obviously, part of it is, close to what's been happening in Iran. We did have limited exposure to the UAE, which, I think still is a good structural story. The Saudi market's held up well, but it's mainly been propped up by government money. But, until we get a really clear direction on what's happening in the peace process and any sort of rebuilding of the region, what we see is less interest in Dubai, less tourists, less business movement. The rest of the EMEA, South Africa's been quite interesting on the commodity side, but since end of March, commodities have been the laggard of those three areas: AI, sort of technology, industrials, commodities. So we haven't changed positions there. Yeah, I mean, look, the outlook for the second half of the year, from an economic perspective, is reasonably robust. We have the US economy growing, probably growing a bit faster than people think, despite all the political risk that's been happening and a sort of elevated oil price. I mean, if the political risk in the region calms down and the oil price remains where it is now, then that would be obviously positive for growth. We've got the US spending money on the big, beautiful bill. But on the other hand, we're probably not likely to see the catalyst of interest rate cuts. And most investment banks and economists have taken their cuts for this year to next year. But the robust growth and earnings coming through. And then secondly, we've got, globally, this reindustrialization, huge capex plans in the US, in Europe, in Asia. And that's very, very positive for growth. But yet again, it probably doesn't mean rates coming down. And then we have the political situations which have been happening in Iran, that could flare up any time. So, the macro's in an okay situation. And that's pretty positive for overall earnings and risk on. When we get to the market outlook, the market outlook really has been driven globally by AI. It's been a very narrow rally, whether it's the US or Europe doesn't really have the theme, so they sort of lag behind. And certainly Asia and Japan, as we've mentioned in other commentary. And I suppose the question is, does it widen out? Does any easing of political tensions or a really lasting peace deal in in Iran, does that lead to a widening out of the market? Widening out into industrials, cyclical pickup, and then commodities, etc. Also, we have to appreciate the markets are expensive. They've gone up a lot. We've had one of the best starts of the year in history. There is likely to be a pause or consolidation, but the fundamentals remain in place.